Welcome back, traders. It's Carlo from Blueberry with the week ahead. Let's take a look at some of the key data events this week and what is likely to be top of mind for traders. Last week, US equity markets finished on a disappointing note, especially after softer than expected US CPI data, which failed to revive risk sentiment. You may recall last week that AI disruption fears gripped global share markets, with many sectors selling off, and other risky assets such as Bitcoin failed to breach 70,000, and even the mighty Australian dollar lost ground against the US dollar. This week, the AI Impact Summit in India will be in focus as traders look for any AI-related headlines. Let's take a look at some of the economic data releases that may impact markets this week. At the start of the week, Canadian CPI. RBNZ monetary policy statement where expectations are for no change to the official cash rate of 2.25%. Thursday, Australia's employment data. Recall last month we saw a strong 65,000 increase in jobs. Forecasts are centred around 20,000 jobs to be added for the month of January. The Australian employment data is another key release that may well shape the RBA's thinking towards a possible further rate hike over coming months. And later in the week, UK CPI, retail sales and PMIs across Europe and United States, ending with the Fed Reserve's preferred measure of inflation, the core PCE price index. Products that have been top of mind for traders last week are most likely to be popular this week once again. Gold, silver, Bitcoin, the US equity market indices, the Nikkei 225, the yen. I'd like to look at the Aussie US this week, given we have the employment data coming out on Thursday. You can see that the Aussie has been performing very strongly since November last year in a daily uptrend. We have though seen risk off sentiment pick up last week, and with that, the Aussie has come off its highs. It reached a high of close to 71.50 last week. Now you can see the stochastics below have turned over, suggesting possible negative price action in the next few trading sessions. If we are looking for, as traders, we are looking for support levels. We're right on one here, 70.50. And I'd like to point out that prices have hugged and bounced off that yellow moving average, which is the 20-day exponential moving average. That comes in around 69.80. Now, if we do see a sharper sell-off in equity markets globally, whereas the AI disruption fears pick up, and traders might be looking for deeper corrections in the Aussie, then the 69 cent mark around here would be the next level support that traders might look for. What's happening with the gold price? Where to from here? Well, last week we saw gold consolidate between a range of 5,000 and 5,100 US. And this is on the back of the huge sell-off we saw a few weeks ago from around 5,600 to 4,400. We've already retraced 61.8% Fibonacci level. There's been an increase in bearish sentiment last week. Is money flowing back into safe haven assets and thereby gold as well? Well, we have seen money flow into US Treasuries with the rally in Treasuries towards the end of last week, which saw US 2 yields fall to 3.4% and US 10 yields fall to 4.05%. So if traders expect bearish sentiment to continue this week, we do need to see gold hold support around 4,900 or 5,000 level, the lows of last week, and prices do need to break that 5,100 level to receive any momentum. At this stage, the stochastics oscillator showing that prices are likely to continue to range trade. At the beginning of February, the Bank of England left the cash rate unchanged at 3.75%. Focus will be on this week's UK CPI, employment and PMI data. Key levels for traders: 133.40, recent swing low point in January, and 138.50, where we can see 3 touches, thereby making that a relatively strong resistance level. But there is likely to be plenty of trading opportunities for the remainder of the week. That concludes my analysis. Thanks for watching and good luck with your trading. I'll see you in the next video.